The commodity futures exchange is a marketplace for people, companies interested in buying or selling commodities based on information today and the perception of where prices will be in the future. There are two types of prices, cash prices and future market prices. Cash prices, also called spot prices, are today's price for a product that is delivered today. Futures market prices is today's prices for products that will be delivered on a set future date. The three primary purposes of the futures market are, first, that the market is a place of price discovery. Second, that it serves as a mechanism for people transferring cash price risk and uncertainty to other people. Third, it allows for public access to information for decision making.
In the futures market, futures contracts are bought and sold. A future contract is an agreement or contract to buy and sell a certain commodity asset at a future set price. To be able to participate in the futures market, there are some costs that need to be paid. To buy and sell, you need a broker, so you'll need to pay a brokerage fee. Then for every contract, there will be a margin required, which is a small percentage of the value of the transaction that is needed as down payments. This allows you to have a high financial leverage, as you can invest a lot without having all the capital. Though, if the market moves against you enough, there will be a margin call for more money. The live cattle margin is $1,600 per contract. When the futures contract expires, the buyer has a responsibility to receive and buy the asset when the contract expires, while the seller has a responsibility to sell and receive payment for the asset at the price set when the contract was made.
I'm a buyer and I want to buy now because I think it's going to be a bull market.
The buyer has a long position. They are responsible for agreeing to buy the commodity at the end of the contract at the fixed sale price. They are also called bulls, or take a bull stance, as they expect the market price to go up. They want to buy now to buy low. The buyers will make money if the future price rises.
And I'm a seller, and I want to sell now because I think it's going to be a bear market.
The seller has a short position. They are responsible for agreeing to sell the commodity at the end of the contract at the fixed sale price. They are also called bears, or take a bear stance, as they expect the market price to go down, so they want to sell now to sell high. The sellers will make money if future prices fall.
I'm a speculator. I look to buy low and sell high.
Speculators are the primary participants in the futures market. They can be individuals or a firm that will accept the risk to make a profit. Speculators both sell and buy contracts at different prices to make a profit. Their one basic rule is to buy low and sell high. For the speculators to make money, they need to sell contracts for money and then buy.
So as the speculator, I think the price of the contracts for live cattle is going to rise. So I want to buy these contracts for live cattle now, and when the price rises for these live cattle contracts, I will then sell the same number of contracts I bought. If the prices don't rise, then I will set a limit for if the price drops too low, then it will automatically sell the contracts to mitigate my losses.
I have 40,000 pounds of live cattle to sell in August, so I want to sell a futures contract now for August because I think the price is going to fall. I want to sell now at 160.875 cents per pound while it's still high so I can make money.
And I'm going to buy this contract for live cattle now, as I think the price for live cattle is going to rise. So I will buy the contract for 160.875 cents per pound and sell it later for a higher price and make money by buying low and selling high.
I'm going to buy this live cattle contract at 171.300 cents per pound, as I think the price of contracts are going to rise even higher, so I want to buy now to make money.
The futures market prices will fluctuate as the outlook for supply and demand change. If there is an illness that causes cattle to go sick and die, that could affect the prices of live cattle contracts.
Buyers and sellers can also use hedging to manage their price risk. Hedging is an effort to lock in a price now rather than waiting and taking the market price when you are ready to buy or sell your product on the cash market. To hedge, you can take a position in the futures market that is opposite to the position in the cash market. So if you plan to sell live cattle in the cash market, You would sell a contract or contracts for live cattle in the futures market now, and then you would be selling the live cattle in the cash market. Then you buy the same amount of contracts for live cattle as you sold earlier. The law of one price says that the cash price and the futures price should overlap at some point in time. So if cash and futures price move in the same direction, these gains or losses from hedging should balance out.
I want to sell my cattle on the local cash market in August, but to hedge my risk, I'm going to sell a futures contract of 40,000 pounds of live cattle now. When August comes, I'm going to take my cattle to the cash market to sell them and also buy a futures contract for live cattle for August.
I want to buy live cattle in August. So I'm gonna buy a futures contract for live cattle now, and then come August, I'm going to buy live cattle at the local cash market and also sell a contract for live cattle to hedge my risk.